Welcome to the HFR Podcast. My name is Anika Akil, and I lead HFR Media. HFR is the established global leader in hedge fund data and analysis since 1992. To learn more, visit hfr.com. I'm delighted to welcome back to the HFR Podcast today macroeconomist Peter Berezin. Peter is Chief Global Strategist and Director of Research at BCA Research, which provides global investment research to leading financial institutions. He's formerly served as Senior Global Economist with Goldman Sachs and at the IMF, and he's recently been making quite a name for himself as Wall Street's biggest bear. We are interested to revisit his expectations for the foreseeable future. Peter, welcome back.
To be back.
So let's kick this off with what is the best case and the worst case scenario for the next 3 to 6 months in the US and the global economy?
I think the best case scenario is one where President Trump removes most of the tariffs that he's introduced since he was inaugurated, and the economy, which has been showing signs of slowing already, starts to reaccelerate, but not too much, because we do have some concerns over inflation that go beyond the tariffs. The economy is still operating near full capacity. So we need to get a bit of a Goldilocks scenario going where growth is sort of close to trend, but not above trend, because that would be inflationary, but not below trend, because then unemployment would rise. If we can get that Goldilocks scenario, then of course stocks can move higher.
Worst case?
The worst case scenario is one where we end up kind of in a stagflationary environment where the tariffs stay put, could even rise if these deals that Donald Trump is talking about, but other countries don't seem to be willing to confirm, if those deals don't pan out, if the sector-specific tariffs that Trump has pledged are actually applied, then inflation will rise, growth will weaken, and that will put the Fed in a very difficult situation because both sides of their dual mandate will be under threat. And so we'll probably end up in a situation then where stock prices are considerably lower.
So one would hope that the most likely scenario lies somewhere in the middle. Would you agree? What do you think is the most likely outcome of tariff negotiations between US and China?
Well, I think most likely tariff rates will fall from where they currently are, specifically on China. The problem is that we're starting from a point where they're really high. So the effective U.S. tariff rates is close to where it was during the 1930s at the moment. And I'm not sure if bringing the tariff rate on China down from 145% to like 60% would really help matters that much, because even at 60%, most of the trade between the two countries is going to be cut off. You really have to bring it down to like, 10, 20%. For that to happen would require China to make massive concessions. And I don't think they want to do that. In fact, they're probably kind of sitting back and enjoying the show, watching the U.S. Kind of shoot itself in the foot, both economically and perhaps more importantly, geopolitically, sever all of these long-standing alliances. I'm not sure if China necessarily wants to get in the way of that. So a deal could be reached, but I'm very skeptical that it will be reached anytime soon.
Right. You've touched on a lot that I want to drill into a bit. How about the other trade partners? We have a 90-day, which we've used some of that already, period of relief before those other tariffs that were announced go back on. Do you think those tariff threats die a quiet death, or will they be revived after those 90 days are completed?
Well, the problem here is that the U.S. already has something close to free trade with many other advanced economies. So in recent days, President Trump has been talking about a trade deal with South Korea. The U.S. has a free trade deal with South Korea already. So what exactly are we going to achieve by opening up negotiations. I suppose it's possible that little things will be tweaked on the margin. That wouldn't address the trade deficit that the U.S. has with Korea and many other countries. And you can say, well, if there's a trade deficit, that means there must be some sort of hidden barriers that we're not seeing. Not necessarily. The reason the U.S. runs a trade deficit with many countries is because foreigners often prefer to buy U.S. assets rather than U.S. goods. The balance of payments has to balance. So if the U.S. runs a current account deficit, then it's going to run a capital account surplus by definition. And so, you can kind of make the U.S. a very unattractive place in which to invest, and then the dollar will weaken and import prices will rise and exports will become cheaper. But, at the expense of what? At the expense of sabotaging what has historically been a wonderful place for foreigners to invest. And that's not a bad thing. The U.S. Gets all sorts of things from the rest of the world, and in return, they hand over little papers with pictures of dead presidents. That's not a bad deal. If the U.S. had mass unemployment, of course, a trade deficit would be problematic, but it doesn't. And so if you reduce the trade deficit in a full employment economy, all you're going to do is shift workers from high productivity sectors of the economy to low productivity sectors that currently are activity of which currently is being done abroad. That's not necessarily a smart economic strategy.
So what about slack in the labor market? There's a lot that's been going on the immigration side, and there is a distinct decrease in the number of foreigners arriving on U.S. Soil. Do you have concerns about labor market slack?
Yeah, so labor market slack is a little bit tricky to measure when you're close to full employment. And when you get to full employment, the labor supply curve ends up being very steep because everyone who wants a job has a job, so you can't really increase labor supply at that point. So if you have kind of this very, very steep labor supply curve and labor demand starts to fall, but you're still sliding along that vertical portion of the supply curve, you don't see falling employment. You don't see rising unemployment. Rather, what you see are declining job openings and declining wage pressures. So you can actually have this very benign disinflation that takes place when labor demand is falling at a time when the economy is near full employment. And that's exactly what we saw in late 2022 and into 2023, and something that we forecasted. I think we're one of the few research houses that forecasted this kind of benign disinflation, but there was kind of a real theory behind it. The problem now is that we're no longer sliding down that vertical portion. We're probably close to the kink in the labor supply curve, meaning that if labor demand were to fall further, we could begin to see an increase in unemployment. And that's where this beverage curve comes in. The job openings rate right now is around 4.5%. It used to be 7%. It used to be really, really high. Like 2 years ago, anyone who lost a job could walk across the street and find new work. That's not the case now. 4.5% job openings rate is exactly the rate that Fed Governor Christopher Waller has identified as marking the kink in the beverage curve, meaning that if openings were to fall further, then we would start to see rising unemployment. And indeed, the real-time measures of job openings do suggest that they've continued to fall since the official data was released for February. We don't even have March data yet. But if you look at the real-time data for March and April, openings are falling. And so that does raise the risk that we could start seeing rising initial claims into May and June, and significantly higher unemployment.
Moving to this comment that you had about investment in assets, do you have a view on whether the weakening of the dollar is due specifically to the stock market sell-off, especially of the Magnificent Seven stocks, versus the dumping of U.S. Treasuries? And then are we imperiling the dollar standing as a reserve currency here?
To some extent, although getting kind of accurate data on whether foreigners are dumping U.S. assets because of the trade war or because of something else is quite difficult. I suspect actually what's going on is that foreigners and U.S. domestic investors are revising down their expectations of sort of long-term growth for the U.S. economy, both because of these sort of poorly thought out trade policies, but also because there are other structural issues that the U.S. has to confront, especially around the big fiscal deficit that most likely will only get larger if these unfunded tax cuts are passed. And so I think there's kind of this feeling, well, if the U.S. might not grow as quickly in the future as we thought, that growth differential is going to shrink. And so that means that returns on U.S. assets will be somewhat lower than previously thought. And that kind of based on standard economic theory should lead to a decline in the value of the U.S. dollar. And that's exactly what we've seen over the last month or so.
So would you say that so far, the Fed's standing back, letting the markets do their job as far as communicating essentially their reactions and their expectations in response to these policy shifts? Is there an upper limit to the ability of bond vigilantes to discipline policymakers?
Well, of course, at some point, the Fed would step in and quell disorderly bond sell-off if it imperiled the economy. The question is, where is that point? Now, if we had kind of liquidity-driven issues that pushed up yields, I think the Fed would step in quite quickly. On the other hand, if we had a situation where yields were rising because the Trump administration was really pushing for a large tax cut, unfunded by meaningful and realistic spending cuts, at that point, it would be quite difficult for the Fed to step in and buy bonds because what would it be doing in effect? It would be monetizing the debt. It would be basically funding the government through its own balance sheet. The Fed has a legal mandate to maintain price stability. Debt monetization would not be consistent with that mandate. So if we get kind of a true fiscal crisis, then yes, the Fed would eventually step in, but only once a recession was basically inevitable. They're not going to step in quickly to sort of bail out the policies that led to the spike in yields in the first place.
Would you feel comfortable putting sort of a number on the probability of stagflation materializing?
I think it depends a little bit on what you mean by stagflation. If we're talking about like an increase in inflation over the next 12 months, I mean, already the market expects that. If you look at, say, 1-year CPI swaps, they're pricing in inflation of around 3.25% in 12 months. Now, if that's stagflationary, typically stagflationary is defined a situation where you have elevated inflation over a long period of time, unmoored inflation expectations, and sluggish growth. Right now, long-term inflation expectations, at least market-based inflation expectations, still look okay. The survey measures have come up quite a bit, but they tend to be a little bit more volatile. So I don't think we have kind of 70s style stagflation in which inflation expectations have become unanchored, and that's driving a wage price spiral. We don't have that, thankfully. But the Fed needs to maintain some vigilance to ensure we don't end up in that situation. And the way it's going to maintain that vigilance is by being prudent in cutting rates until inflation starts to go back towards its 2% target.
What would you advise the administration if you had the opportunity on how to tackle the budget deficit, how to achieve some of their goals of reducing US borrowing, potentially reducing consumption of cheap foreign goods? How would you tackle it?
Yeah, so you're quite right that these two deficits, the so-called twin deficits, the budget deficit and the trade deficit, are linked. So economically, the current account balance, which is basically the trade balance expanded to interest payments, is equal to the difference between what a country saves and what it invests. So you can reduce the trade deficit by reducing investment spending. That wouldn't be a good way of doing it. It would hurt growth. Or you could reduce the trade deficit by increasing domestic savings in the economy. And that would be a good way of doing it. Now, the question is, how do you do it? Well, you don't necessarily need the private sector to save more, because if the private sector saves more, it's probably because they're worried about their job prospects or the value of their homes or stock portfolios has fallen. What you really want is the government to save more. Right now, the US government is running a budget deficit of 6.5% of GDP. It's a very, very high number, given that the unemployment rate is only 4%. We need something closer to 3.5% of GDP budget deficit to stabilize debt to GDP ratio. So the deficit now is completely above and beyond the level that one would regard as necessary for fiscal sustainability. Now, how do they do it? Well, of course, you could cut spending, but that's hard. And, President Trump has basically ruled out cutting Medicare, Social Security, defense spending. You can't cut interest payments because the bond market decides what those are going to be. And if you look at the rest of the budget, it's just not very large. So unless there are political decision made to cut these entitlement programs, which I don't think is going to happen, then you have to look at revenue. There's no other choice. You have to either raise taxes or at the very least put some more resources into tax collection. I think this has sort of been an underappreciated mistake that's taken place recently, getting rid of all these people at the IRS. I realize people don't want to pay taxes. I get it. But, in the US, there was something like over the last 5 years ago, 100 people who earn more than $100 million and never even file taxes. And now the statute of limitations has expired. So you got to do more on the revenue side if you don't want to cut those entitlement programs. There is money to be had. And if you don't do it, then as we discussed earlier, those bond vigilantes may very well step in and force you to do it.
Right. And I know you're sticking to your expectation of the stock market falling further. Any thoughts on that to share? Where does that go in the next 3 to 6 months?
Well, right now, the stock market as we speak, it's trading at around 20 times forward earnings in the US. So it's not 22 times as it was a couple of months ago, but 20 times forward earnings is still really high. Like if you look at where we were, for example, between 2015 and 2019, which was a period which didn't include a recession, where we already had tax cuts, the average P ratio during those years was 16.8. So we're at 20 now, and we had a substantially lower P ratio back then when the economy was still reasonably strong. So the market right now, it's not even pricing in a meaningful deceleration in growth, let alone a recession. In fact, if you look at what's driven stocks lower this year, it's been largely the AI plays, the Magnificent Seven stocks more broadly. The 493 companies that are not the Magnificent Seven are almost flat for the year, just down slightly following the recent rebound. So that's telling you that not a lot of economic damage from the trade war has been priced in. And maybe we'll get lucky, but if we do, I think the upside for stocks is limited. But if we don't get lucky, if the trade war persists, if the economy does enter a recession, then the S&P falling to 4450, which is my target for the end of the year, is entirely plausible.
So Peter, in conclusion, I think the biggest question on my mind is this a bellwether for the United States and its position at the head of the global economic order? Are we seeing a paradigm shift being initiated here?
That's a really good question. It's a hard question to answer because it's not clear how much of this is Trump related. I think Thomas Friedman had this very nice quote about Iraq, 25 years ago. Like he said, is Iraq the way it is because of Saddam Hussein, or is Saddam Hussein the way he is because of Iraq? And you can say the same question, like, is the U.S. now in a position where it is because of Trump, or is someone like Trump kind of inevitable anyway, that if even if Trump goes away, you're going to get some populist leader, because there is kind of this risk for investors that going forward, you're not going to have a lot of support for the business community, either from the Democrats, which have sort of moved to the left, or from Republicans, which have become much more populist. Republican parties become much more of a working class party. And so who's going to really support businesses going forward? It's not clear. So from that perspective, there might have been a paradigm shift that's taken place, in which case, then, yeah, I think investors will have to reassess the long-term prospect for earnings growth for S&P 500 companies. Profit margins right now are record high levels. Will they stay where they are in a more dangerous environment for businesses going forward? Probably not. So I think that's the risk for U.S. stock market exceptionalism.
Mm-hmm. That's very interesting too, because I think before Donald Trump came into power the second time around, the widespread perception has been that he would be a leader good for businesses. He would be, great for the financial markets. And I think what I'm hearing is it's just really hard to get this stuff right because there's so many moving parts. So that's interesting to me that you say that. Well, thank you, Peter. I really appreciate your time. And as always, your views are enlightening and thoughtful. And we look forward to having you back on the show, maybe in a few months.
Pleasure. I enjoyed it.
Thank you.
Bye.